Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if this investment company is really making bank or just playing pretend with their fancy financial reports. Get ready, because today we are diving deep into the latest official report from Fidelity PHILLIPS Street Trust concerning their government cash reserves fund. We had some pretty interesting numbers and insights that might just surprise you. Before we dig in, if you love unpacking these financial documents to see what is really going on behind the scenes, make sure you are subscribed. And hey, we've got a fantastic community discussing these things over on our Discord server, linked right down below. Hop in and join the conversation. Alright, let's get right into what this filing is all about. It is basically a yearly report officially called a Certified Shareholder Report that tells us how the Fidelity Government Cash Reserves Fund has been doing. Think of it as their financial report card for the year ending the 30th of November 2025. This fund, Fidelity Government Cash Reserves, is part of a bigger trust, and it is all about holding onto cash reserves, which sounds pretty safe. Right, we're going to see just how safe and profitable it has been. First off, how big is this thing? As of the 30th of November 2025, the fund is managing a colossal $239 billion. That's not billions with a B, folks, that's a lot of zeros. That's almost $250 billion. Now, managing that much money doesn't come cheap. The total advisory fee paid out for this fund was a staggering $850 million. That's a pretty hefty chunk of change. But when you are dealing with hundreds of billions, I guess it's part of the game. So what were they putting all that money into? Well, it looks like they are heavily invested in things like US Treasury obligations, making up 40% of their assets. Then there are repurchase agreements at 36.2%, and US government agency debt at 26.4%. Essentially, they are putting most of their money into government-backed or very safe investments. This makes sense for a fund focused on cash reserves. And how long are they holding on to these investments? The report shows that over 55% of their assets have a really short maturity, like 1 to 7 days. Another significant chunk, about 15%, matures in 31 to 60 days. This shows they are keeping a lot of their investments very short term, which is typical for a cash reserve fund aiming to be highly liquid and safe. Now, let's talk about costs. The report mentions that the fees associated with this fund changed during the year. This often happens due to adjustments in management fees or operating expenses. They explain that variations in class fees are primarily the result of changes in the management fee and operating expenses. When it comes to keeping the books clean, they paid $55,000 in audit fees for the year ended the 30th of November 2025. That's in addition to other fees like audit-related fees, tax fees, and other miscellaneous services. It is standard practice for these funds to have independent auditors to ensure everything is on the up and up. Interestingly, the fees for this specific fund, Fidelity Government Cash Reserves, seem quite reasonable. However, when we look at the fees billed not just to the specific fund, but to the larger Fidelity Management FIDIAMP, research company, and other related entities that provide services to the fund, the numbers jump significantly. For example, audit-related fees for these broader services were over $8.9 million in 2025. This shows that while the fund itself might have manageable audit costs, the overall operational structure supporting it involves substantial expenses. And who's doing this auditing? It's PricewaterhouseCoopers or PwC, a big name in accounting. They billed a total of over $13.7 million in 2025 to the fund and its related service providers. It's a significant amount for accounting services, but necessary for transparency and trust in the financial markets. Now, let's dig into the real meat and potatoes, the financial statements. This is where we see the nitty-gritty of the fund's performance. Here in the schedule of investments, we see a detailed breakdown of where the money is. For repurchase agreements, which is basically a short-term borrowing where securities are sold with an agreement to repurchase them later, they have over $72 billion invested. These are typically very short-term, often just a few days. Then we have the US government agency debt. They have over $63 billion in these investments. These are bonds issued by government-sponsored enterprises like Fannie Mae and Freddie Mac. And the largest chunk, 40%, is in US Treasury obligations, totaling over $95 billion. This includes Treasury bills and notes, which are considered among the safest investments available. This means the total investments in securities, including repurchase agreements, amount to over $245 billion. Now, you might notice the total is 102.6% of net assets. That might seem a little off, but it's common for money market funds to use leverage through repurchase agreements, which can sometimes push the total investment 3 and slightly over 100% of net assets. The negative 2.6% in net other assets and liabilities represents things like accrued expenses or other short-term obligations that reduce the net assets. In this case, it's about $6.2 billion. So after everything is accounted for, the net assets of the fund are a whopping $239.5 billion. Looking at the statement of assets and liabilities, we see that investment in securities is valued at almost $245.8 billion. Cash holdings are around $939 million. And there are also receivables for investments sold and fund shares sold, which are essentially money owed to the fund. On the asset side, the total is over $248 billion. And on the liabilities side, we see things like payable for investments purchased, which is over $7.9 billion, and payable for fund shares redeemed, adding up to about $9.2 billion. This leads to net assets of approximately $239.5 billion, which aligns with what we saw earlier. Now, let's check out the statement of operations. This tells us how the fund made and spent money over the year. The fund earned a massive $10.2 billion in interest income. That's a testament to the huge amount of money they are managing and the prevailing interest rates. On the expense side, the management fee alone was over $850 million. Then there are other costs like custodian fees, trustee fees, registration fees, audit fees, legal and miscellaneous expenses. After all expenses, the net investment income for the year was over $9.3 billion. This is the profit generated from the fund's investments. They also had a small realized gain of about $1,194 on investment securities from unaffiliated issuers. So the total net increase in net assets from all operations for the year was over $9.3 billion. The statement of changes in net assets shows the year-over-year movement. For the year ending the 30th of November 2025, the fund saw an increase in net assets of about $3.99 billion. This is from the operations generating over $9.3 billion, but then distributing around $9.37 billion to shareholders and accounting for share transactions. Compared to the previous year, the net investment income was slightly lower in 2025 at $9.37 billion versus $11 billion in 2024. The total increase in net assets for 2025 was about $3.99 billion, which is down from about $6.85 billion in 2024. This indicates a slight slowdown in asset growth compared to the prior year. Looking at the supplemental data, the net assets at the end of 2025 were around $239.5 billion, a healthy increase from $235.5 billion in 2024 and $228.6 billion in 2023. So despite the slower growth rate compared to last year, the fund is still growing. The financial highlights section gives us a per share view. What's striking here is that for 5 consecutive years, from 2021 to 2025, the net asset value, or NAV, has remained at exactly $1.00 per S-share. The income generated per S-share, net investment income, was $0.040 for 2025 and $0.049 for 2024. This means the fund paid out distributions that essentially returned this income to shareholders, keeping the NAV stable. Their total return for 2025 was 4.07%. This is the actual percentage gain on your investment considering income and any changes in value. For 2024, it was 5.02%, and for 2023, it was 4.67%. These returns are solid for a fund focused on cash reserves, especially when compared to inflation or other safe haven assets. Looking at the ratios to average net assets, the expenses before reductions were 0.37% in 2025. This percentage represents the operating costs of the fund relative to its size. The expenses net of waivers were also 0.37%. This suggests they weren't heavily relying on waivers to keep costs down for shareholders. The net investment income as a percentage of net assets was 4.00% for 2025, down slightly from 4.90% in 2024. This reflects the earnings power of the fund's assets. Now, the notes to financial statements fill in a lot of the details. For investment valuation, it mentions that securities are valued at amortized cost, which approximates fair value. This is a common practice for money market funds. Ensuring stability, they are categorized as level 2 under the fair value hierarchy, meaning the inputs used for valuation are observable, but not directly quoted prices in active markets. For tax purposes, distributions paid out are largely considered ordinary income. For 2025, they paid out almost $9.4 billion in ordinary income distributions, and the extensive table detailing repurchase agreements gives us a glimpse into how they manage short-term borrowing and lending. They have agreements with numerous financial institutions, with collateral typically being US Treasuries or agency mortgage-backed securities. The total value of these repurchase agreements is over $86 billion. It's a complex web of counterparties and collateral, but it's how they efficiently manage cash in the short term. The report states that all investments are categorized as level 2 under the fair value hierarchy, meaning they are valued using observable inputs that are not necessarily quoted prices in active markets. This is standard for this type of fund. The auditor PricewaterhouseCoopers LLP gave a clean opinion on these financial statements. They confirmed that the statements present fairly the financial position and operations of the fund. This is pretty standard, but always good to see a positive endorsement from the auditors. Finally, the section on the basis for approval of the investment advisory contract and management fees is quite detailed. The Board of Trustees, including independent trustees, reviewed the contract extensively. They looked at the quality of services, investment performance, the competitiveness of fees, the profitability of FMR and its affiliates, and economies of scale. The board noted that the fund's management fee rate ranked above the competitive median for 2024, but its total expense ratio ranked below the median for the total peer group, while ranking above the median for the asset size peer group. They also considered that the fund has a variable management fee that covers various services beyond just portfolio management. After reviewing all this, the board concluded that the advisory contract and management fees are fair and reasonable, renewing the contracts through the 30th of September 2026. So, what is my take on all this? The Fidelity Government Cash Reserves Fund, despite managing an enormous amount of money, appears to be run very conservatively. They are heavily invested in US Treasury obligations and similar safe assets, which is exactly what you'd expect for a money market fund. The NAV has been incredibly stable at $1 per share, with the returns being distributed to shareholders, which is a sign of a well-managed, low-risk fund. The management fees are substantial, as expected for a fund this size, but the board has reviewed them and found them to be fair. The slight dip in growth in 2025 compared to 2024 isn't alarming given the sheer scale of assets and economic conditions. In essence, it's doing exactly what it's supposed to do, preserving capital and providing steady, albeit not spectacular, returns. The biggest risk here is really just market conditions affecting interest rates and potentially the value of those short-term government debt instruments, but that's inherent to this type of investment. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.